precious metals have done very well during periods of time when savers and investors were concerned about the maintenance of purchasing power of their savings. There are other reasons why gold and silver have done well too. But when I look back over my career, which goes back to the beginning of the 1970s, when there have been periods of time when savers and investors were nervous about the maintenance of purchasing power, precious metals have done very well. I remember instructively, the decade of the 1970s. At the beginning of that decade, we'd come off really 2 decades of uninterrupted growth post-World War II. Another very, very, very benign period. Interest rates were low, economic growth was high, all that kind of stuff. We had all kinds of borrowed money. And the interest rate relative to the inflation rate was low. Beginning really in 1966, we had inflation in the United States that exceeded the interest rate that was being paid on deposit products and savings. The very low interest rates also subsidized equities in the sense that the dividend yields were competitive with savings products because the savings products didn't pay very much, something eerily similar to today. When they decontrolled the gold price, gold reacted almost like a coiled spring. Well, that's not true. It took 2.5 years or something like that from the beginnings of the insurmountable evidence around inflation to inflationary expectations among the population. There was a lag time because people had lived through 2 decades of benign economic climate. But when gold started to move, of course, from a price-controlled bottom, it moved pretty dramatically from $35 an ounce in 1970, if my memory serves me correctly, to $210, $212 an ounce in 1975. In 1975, the US Fed famously allowed interest rates to rise, which strengthened the US dollar and took the gold price from $200 to $100. A really, really, really ugly cyclical decline in a secular bull market. That increase in the interest rate at the same time that, remember, the US government was trying to win both the war in Vietnam and the war on poverty and pay for both, was unsustainable. The Fed lost its nerve, backed off on the interest rate, and gold went on a romp from $100 an ounce to $850 an ounce by the end of the decade. The point of this isn't merely to recite history, but rather to say that the gold price is pretty sensitive around real interest rates and their impact on the strength of the currency. So if you are one that believes that the governments will be able to continue to have their way with markets and through quantitative easing and other measures, keep the return that savers enjoy, if that's the right phrase, for their savings below the rate of destruction of their currency, I think you almost have to be bullish about gold. Let's look at some of the drivers. The first driver, of course, would be quantitative easing. David, if you did it, it would be called counterfeiting. If you printed up Russells and attempted to introduce them as a medium of exchange with no backing, you would be rightly thrown in prison. When Parliament does it, it's policy and it's widely applauded. In the US government, in the last 2.5 years, the float of US dollars has increased by almost 40%. A rate of increase that I would suggest is not dictated by the growth in the economy, but rather the needs of the legislature. So quantitative easing, really truly defined as counterfeiting. And if anything should make you concerned about the efficacy of the currency, the fact that the legislature can increase the float by 40% for no apparent reason should make you concerned, I think. The second is debts and deficits. And I don't want to give a British example, but in the US, the on-balance sheet liabilities of the federal government are almost $30 trillion, or 22 net of their own balance sheet. They're servicing this debt with a budget that's in deficit $3 trillion a year, which is to say, rather than servicing the debt, rather than amortizing the debt, they're adding to the debt. More challenging in both your country and mine are the net present value of off-balance sheet liabilities or entitlements. Medicare, in your case, the national health system, Medicaid, things like that. In the United States, that number, according to the Congressional Budget Office, not some cranky old libertarian saver, exceed $120 trillion. So if you add the $22 trillion in on-balance sheet liabilities with 120 trillion off-balance sheet liabilities, you come with a rather eye-popping $140 trillion of net present value of future obligations, serviced by a budget in deficit. And then you look at the credit quality that's manifested by that, and you accept that risk for a negative real interest rate, which is to say you lend money to a debtor, the US government, who has acknowledged that they can't pay it back, and you don't demand a real rate of return on your savings. You take that implied credit risk, you assume the destruction of the currency, and you lend your money at 1.6 or 1.7 in a world where your purchasing power is being destroyed at the rate of 6.5. And anybody who isn't concerned about the maintenance of purchasing power in their savings in that circumstance is somebody who doesn't understand very much about the fundamentals of arithmetic. Mm-hmm. It's very difficult to subtract 6.5 from 1.6 and come up with a positive sum. At least from my point of view. And then if you manifest those three concerns with two notes, one we've gone through before, which is to say that 40% of the savings and investment assets of the biggest investors in the world is comprised by debt instruments, which are now guaranteed at this interest rate to lose the money. At the same time that the political forces can't allow interest rates to rise enough to give them a positive rate of return. And the second, which is the extraordinarily low market share of gold and silver as savings and investment assets relative to historic norms. And let me do the arithmetic for you there too. It's estimated in the United States, and by the way, I understand that you opened a location in the United States, so welcome.
Thank you very much.
In the United States, it is estimated that precious metals and precious metals related investments comprise a little less than 1/2% of the total value of savings and investment assets in the US market. Interestingly, that compares with the 30-year mean of between 1.5% and 2%. So if the combination of quantitative easing, debt and deficits, and negative real interest rates causes people to be concerned about the maintenance of their purchasing power in other savings and investment assets, and they act just a little bit, gold doesn't need to win the war against bonds. Gold doesn't need to win the war against savings products. It just needs to lose it less badly.